Hi, everybody. Welcome to this special edition of our special Made for YouTube series. And today we're going to focus on duration funds. So, over the last 1 or 2 years, many of us have become familiar with, funds which are focused on credit ratings, right? Which are often called credit funds. There's the other side, which is duration funds, right? So there are a total of 16 types of debt funds, and the large majority of them 10 are actually funds which are based on duration. Now, why do I say funds which are based on duration? Well, that's because SEBI uses certain criteria to make distinction between different categories of funds, right? So I'm going to actually also link to the video of what is the differences between each of the debt categories, a video which we had done earlier, and maybe you could also see that later. But for now, suffice it to say that the definition that SEBI has for duration funds is basically something which is based on MACAULAY duration. Now, what exactly is MACAULAY duration? We'll get to that during the course of the video. But basically, that's the criteria, right? So they will say the MACAULAY duration of a fund should be whatever X days, or it should be X plus Y days, etc. Right? So there are certain ranges that they have given, and based on that, fund managers will select funds, right? So let me give you an example. For example, this range starts from 1 day, right? That's called the overnight fund. Then you have liquid funds, ultra short duration funds. Liquid funds can invest in any bonds up to 91 days, where the Macaulay duration should be up to 91 days. Then you have, ultra short duration funds where the Macaulay duration should be between 3 to 6 months. So what this means is that the average of all the bonds that a fund manager has bought in that portfolio, the average of that should fall between 3 to 6 months, right? And this goes all the way to more than 7 years, which becomes a long duration bond fund, right? And then there is one which is a dynamic bond fund where there is, the flexibilities on the fund manager, right? You choose any duration, choose any credit rating, put it together. That's your dynamic bond fund. So now let me invite an expert to join me in helping us understand this whole concept of duration funds. What are the peculiarities? How do you decide when to invest? How do you choose the best fund, etc.? So joining me now, I have R. Sivakumar, who's the head of fixed income at Axis Mutual Fund. Hi, Siva. Thanks very much for joining in on this YouTube special. I want to first start off with just this. Like, why is the life of a bond so important that SEBI has actually listed it down as a criteria in, defining a whole category of debt funds?
Yeah, hi Sumaira. First of all, thanks for inviting me on this show. It's quite exciting to be here. And when you look at a bond or any kind of an investment which is fixed income in nature, which is related to where you get an interest at a regular period of time, there are two critical risks. One is the interest rate risk, or the relationship between the value of that bond and interest rate, and the other is credit risk, the credit worthiness of that bond. So let's set aside the credit risk for a moment and focus on the interest rate risk. Essentially, the interest rate risk or the duration risk of a bond, it specifies the relationship between changes in interest rates and changes in the value of the bond. That is to say that different duration buckets or different duration ranges lead to different amount of price volatility of a bond, and because it's such an important uh, uh, nature, it kind of specifies the nature of the bond. I think the regulator has essentially said that we have to be very clear, the mutual fund industry has to be clear in communicating to the investors that this is a specific duration range, which kind of communicates what is that interest rate risk to investors.
Okay. Uh, so based on that, it starts with, say, 1 day, right? And it goes up all the way to more than 7 years. Now, the problem that we as laymen often face is that we don't know. I mean, I can imagine that there is a difference between investing for a 1 day, in a fund that invests for a day, and 7 years. The confusion arises when I don't know whether I should invest in an overnight fund or a liquid fund or an ultra short duration fund, or even say a short duration fund, right? Because my need may be anything from, say, a few days to a few weeks, and almost all of these funds satisfy that need, even a money market fund for that matter, right? So how does an investor know when to select which fund, especially in this up to 1 year bracket?
Sure. So obviously, in the very short duration, there are actually many different types of funds. You have highlighted most of those categories, and there it can be daunting for someone who's looking at it for the first time. Why do you have these kind of maybe 5 or 6 different categories of funds, which largely all seem to be hovering around the between 1 day to a year or so in terms of duration range. So it can be quite daunting. My first advice is please speak to a financial advisor or a planner, because they can really help you in understanding this. But from a lay person's understanding, many of these funds will be quite suitable if you are looking to invest for periods of, let's say, up to a year. Most of there's a concept in our fixed income investing which is called duration matching. That is, match the duration of the portfolio with your duration of holding. So if you, for example, have a holding period of 1 year, then most funds which have durations up to 1 year will be quite suitable for that holding period. Of course, if your holding period is going to be, let's say, 3 months, and you're holding a fund which has got a 3 years duration, that's quite mismatched. So ideally, try to find a fund which has similar duration to what you want. Now, there are some important caveats here. One is, what if you need the money early? So I've come into a 3 year fund thinking I have 3 years holding period, but I actually need the money in 3 months' time. So be prepared in such situations that there may be some volatility which goes against you. Well, of course, it could be favorable. Markets may have worked in your favor in those 3 months. So it's not that you will necessarily lose money or that you would have significant volatility. Bond markets, while they can be volatile, aren't as volatile as equities or other assets. So, but be prepared that you may not exactly meet your specific yield or return expectations if your horizon is mismatched.
Okay. And, just to clarify for people who are watching, when we say an overnight fund invest for a day, doesn't mean you have to invest for a day, right? You can still invest, for 7 days or 10 days. It's just that that fund or the fund manager will keep renewing that investment
Yes,
daily.
yes, yes. You're absolutely
Right.
right. All these categories are defined by in terms of the, as you rightly said, the average duration. And in the case of overnight, well, our average and actual duration is 1 day. But if it's, for example, in an ultra short-term bond fund, which the regulator has defined as between 3 months to 6 months, it doesn't mean that each bond is 3 months to 6 months. It just means that the average is, and that's for the fund manager to decide, should I keep more of my money in certain types of instruments which are, for example, closer to 3 months, closer to 6 months, or maybe a mix of less than 3 months and, let's say, 1 year securities, which gives me an average of between 3 and 6 months. So that is where I think the fund manager's role comes in. From an investor perspective, like I said, just match it to the closest duration bucket to your investment horizon.
Okay, and that is exactly the concept of Macaulay duration, right? Like Shiva mentioned, that every fund manager will not be buying bonds which only fit in that 3 month to 6 month bracket. They may have, longer or shorter, but the average of the whole, set of bonds that they have collected in the portfolio of that particular fund should fall between 3 to 6 months, right? Shiva, the other thing is that, there is also this modified duration, right? So, which is a more important thing for an investor to track, or do they just go by the definition that SEBI has provided, align it to their goals, and that's it?
Yeah, the good news is that Macaulay's duration and modified duration are always very, very close to each other. The difference is where it's just 5%, 7% of the value. So a 10-year will be maybe 9.5 years. That is, Macaulay's duration of 10 years will be about 9.5 years in modified duration. So that's all the differences, about 5%. So it's not something we need to keep in mind when you're making these kind of decisions. They are very, very aligned. The modified duration is a more true representative of the interest rate risk, although the Macaulay's duration does come very close.
Okay, but since you said it's sort of defines the interest rate risk in a fund, does it really matter for an investor to sort of have to monitor this whole mix between rates and yields and their own bonds in their portfolio? I mean, anyway, we don't try to time, or we cannot even even if we try, we can't do it very successfully to time the rate cycle. I mean, should we just ignore the noise then?
Yeah, I think broadly, yes. Most investors should. That's the job for fund managers. So to manage. When, for example, you have a short duration bond fund which goes from 1 year to 3 years, is it appropriate for that fund to be holding duration closer to 1 year or closer to 3 years? Depends on the fund manager's call about the interest rate cycle, and that is for the fund manager to do. I think if we have from the investor's perspective, the right thing to do is to just find a strategy which they agree with, a holding period they agree with, and a quality of the portfolio they agree with, and then stick across a cycle. Because typically when you have rates going up and down, you may see short-term volatility, but over a cycle which lasts, let's say, a few years at a time, these volatilities also tend to get smoothed out. So, from an investor perspective, don't worry too much about these technicalities about what is the duration today or what is the interest rate outlook for the next couple of months, because that doesn't really affect the longer term returns of that portfolio.
Okay, and that's fair enough. And just another point for people to note who are watching this is, when we're investing in equity funds, people say that you should have a longer time horizon, invest for at least 5 years, and 10 years if you can. But in debt funds, what has been found is that the shorter duration is considered to be a lot safer. Isn't that right, Shiva? That's why we don't see a lot of money in that over 7 year period, because if I have 7 years, why would I not put that money in equity?
Sumaira, is there any evidence to suggest that in over 7 years equity consistently outperforms? I am not sure. I think
This
when
is
you
the
look at
general rule of
yeah,
thumb.
it's a general. And no, why I'm talking about this is a little important. We need to step back and understand what is the relationship between risk and return. Okay, so the expectation is that the higher the risk, the higher the return. So therefore, the longer the duration, hopefully, the more the return. And similarly, going from debt to equity, the more is the return. But actually, the return differences tend to be quite narrow. Over, for example, 5 years, 10 years, and even 20, 25 years in India, the difference between equity and debt returns is actually very, very minimal. So it's the difference is magnifying. So during certain periods when you have sharp run-ups or falls in any one of these assets. So for example, if you have a very strong performance in equities over a let's say period of 1 to 3 years, that looks like a very, very stark outperformance. But that doesn't suggest automatically that over a 5 year, 10 year period, that same returns will get compounded, because it's very, very difficult to look at the past performance to project future in any of these situations. What you actually find is broadly these assets do tend to converge in terms of returns over longer horizon, which is why we recommend something called asset allocation, which is essentially have an allocation strategy. How much of my money is going into equity, how much into fixed income, and don't muck around with that just because of your view. Yeah, it's a little bit plus minus if you do want to make any changes, but it's important to have that strategy in mind and not change it too much. Again, within debt, it's the same thing. Don't try to chase segments of the market which have performed, but rather look at it from a perspective, does this fund suit my risk style, and stay with that strategy for longer rather than worry about, should I buy a long duration fund today or should I be buying a money market fund today? I don't think that it's easy for investors to do, and they should focus on choosing the right strategy.
No, I take your point, but there are weeks where we see such sharp fluctuations in the bond yield. I mean, this week following the budget, right? Um, does that alter asset allocation? I mean, should people look at altering asset allocation at least in weeks which have had very, very sharp moves? Or is it that, we'd anyways know the move in hindsight, right? I mean, we'd only realize there has been a very sharp move over a week at the end of the week. So therefore, just let it be and sit back.
Yeah, a very, very important question. And you have to look at these. This is what we spend all of our time doing as fund managers. That how does a certain external activity, for example, a change in the RBI's monetary policy or the budget, how does that really impact bond markets? And it's obvious when you look at it, for example, from a perspective of long duration bonds, that the week following the budget, you saw a significant sell-off. But the same was not applicable in money market, for example. Money market rates held quite well. And in fact, money market instruments may actually benefit from rising interest rates because they get repriced very quickly. I mean, the simple mathematics of this is that, for example, if you're holding, let's say, a horizon of 1 year and you're holding, let's say, 3 months or 6 months money market instruments, then you will get that same 3-month instrument reinvested 3 more times, and thus, as interest rates go up, they're actually beneficial for your portfolio. So it's not always a given that certain actions on interest rates or yields are always going to be working for or against you in the way you anticipate. And I think that's really that's the reason why I said fund managers, we spend a lot of our time figuring these relationships out. So for example, in this move over the last, let's say, month or so, it has made sense to hold much shorter duration bonds because they have held value even though rates have started to move up. Eventually, when the cycle turns, obviously the portfolio managers, we would want to increase the duration, and longer duration instruments outperform when rates are going down. And that is where I think we add a lot of value in these portfolios, rather than just trying to stick to certain, the individual bonds and holding them at all points of time.
Okay, and just for viewers' reference, when Shiva says, short duration bonds made sense, he doesn't mean that you go and invest in, short duration bond funds for this, few weeks and then move. No, that's not what he's saying. He's saying it's his job to do it in the fund that you're holding, right, Shiva? And therefore, I come to the next question, which is laddering, right? Because that's what you all do so well, and that is what defines a good duration fund manager, right? That they're able to ladder it up, see how things are going to pan out. And what is laddering essentially is that a fund manager will buy bonds of various maturities, various lives, right? So one will be expiring, say X, one will expire in X plus 30 days, one will expire in X plus 60 days, etc. And therefore, they're not taking too much risk in any one bucket. Siva, anything you want to explain to that? I mean, anything investors should know about laddering? And secondly, can this principle be applied when, say, an investor like me or people who are watching are constructing their own debt portfolios?
And this is an extremely important topic, because what laddering does for you, you rightly explained that you don't have to wait, or you could keep getting cash flows at regular intervals, and then you can keep redeploying that cash into the next best instrument, right? If you, for example, have all of your money, for example, in 10-year bonds, and the market moves against you, or there are new opportunities which come your way, you will have to wait a long time, or you'll have to sell that bond in the market, which may or may not be always feasible. So the idea of having laddering is to have consistent available cash flows, and which can be redeployed in better opportunities. This really works in those markets which are relatively less liquid. For example, in government bonds, which are very, very liquid, laddering is less of value, because at any point of time, if I want to realize the value of my portfolio, I can always sell those securities. But for example, if I'm owning certain corporate bonds or some other structured products, so the maturity is the only way I can realize liquidity. So there's a value in doing laddering, but there's also a value in doing laddering in specific types of instruments. So we do this in our, mostly in our credit-oriented portfolios, in the non-AAA portfolios, because that's where the value is the most. Now, the second thing is from an investor perspective, right? How does laddering work? The laddering works in much the same way as it works for funds. That is to say, I keep a ladder of short maturity instruments, because then I can use that to deploy in the future. In much the same way, from an investor portfolio, have a certain part of your portfolio in your cash. It's like an emergency saving, or is it I'm keeping this aside to make a future investment decision. That becomes your short ladder, and you can use, for example, ultra short duration bond funds, liquid funds, etc., to create that part of your portfolio which is stable, where of course, the funds are available to you at all points of time. These are open-ended funds, so don't worry too much about the liquidity, but rather from an interest rate risk perspective, keep a certain part of your portfolio, which is your cash needs, in portfolios which are short duration, and a certain part of your portfolio, which is your core fixed income assets, can be held in a slightly longer duration portfolio. And that's the way you create your own little ladder, and ensure that you have a part of your portfolio which is resilient at all points of time.
And Shiva, debt is really the category where every basis point of return matters, right? Therefore, the skill of the fund manager becomes even more important, right? Now, if I identify a good fund manager, therefore, would it be more advisable to select a category like a dynamic bond fund, or even now the new category of floating rate funds? I mean, will that be more beneficial? Because then I don't have to worry whether, I have chosen a short-term fund or a long-term fund. My fund manager is doing what's best for the portfolio.
Yeah, this is always an interesting question, because when you look at the dynamic bond funds as a category, there are so many styles and strategies within that. It becomes very difficult for someone like me to give a recommendation for that category as a whole. Obviously, given the nature of the product, it is dynamic. You have so many different strategies which go into that, so you will have to really look at that specific fund, the fund manager's strategy before taking a call. But yes, if you do have confidence in a particular fund manager, fund house style, then these categories can add value. But to be honest, that's not the first port of call I would do in any building any fixed income portfolio. I would start actually with short duration funds. The core of any fixed income portfolio should be a short-term bond fund, and you can add anything else which goes as sort of around that. For example, like I earlier mentioned about the need for holding cash. Similarly, the need for a dynamic bond fund or a credit or anything else really goes as an accessory to a core holding which should be in short duration. Most of us as investors, we do have reasonable horizons. We will have horizons of, let's say, measured in years, and not going to be measured in days or weeks. So those most of those investment needs can really be met through slight short duration funds. These are very less, low volatility products, and they offer typically significantly higher yields than these money market or very short duration products. So it's a good mix without having to take significantly longer duration interest rate risk.
Okay, and just for the record, a short duration bond fund is one which has a Macaulay duration of 1 to 3 years. Remember, we've already discussed Macaulay duration, right? Okay, so Shiva, if the short term bond fund is the backbone of a debt portfolio, what are the other debt funds that can optimize that portfolio? I mean, what goes well together?
Yeah, so given that, as you rightly said, the short duration fund is a 1 to 3 year strategy. The way to look at it is what else I can add which increases or decreases my risk. So part of my portfolio which may be in some money market or ultra short, etc., which is a part of the portfolio which I want to keep as a low risk part of my portfolio. And then I can also add on certain higher risk, and this does not have to be only higher duration risk, right? I could buy, for example, a credit risk fund, or I could buy a medium or a longer duration fund, or a gilt fund, etc., which can give me a slightly different type of a risk as opposed to a short-term bond. So the way I would look at it is to firstly look at these categories which are quite distinct from each other. For example, a dynamic bond fund versus a short fund versus ultra short term, and a credit. These are quite distinct from each other, and therefore you do get the benefit of diversifying across these strategies. If you're buying, for example, funds which are very close to each other in duration, then you're not really diversifying. The second is to look at the portfolio quality. I mean, most short-term bond funds tend to have a higher percentage of AAA. Well, not all, but so adding a credit risk is actually giving you a slightly different risk as opposed to the duration risk, right? But if your short-term bond fund already has a lot of non-AAA assets, perhaps it doesn't make sense to add on a new credit. This comes down therefore to the fund-specific choices. But the way to do it is to build a portfolio of different funds which have different risk characteristics to the core, which I would imagine is a short-term AAA portfolio.
Okay, and just to let people know, in case you're wondering, what is a AAA asset, etc., and where do you come to know whether your bond fund has more or less of these assets, or AA, etc., what do these ratings mean? Siva has already promised us that he'll be back very soon on this special YouTube series to tell us how to decode the fact sheet of a debt fund, which is where you'll find all of this information. So we'll do that very soon, in a few weeks, as soon as Shiva has more time. But Shiva, one more question: does credit rating of these bonds matter a lot? I mean, in duration funds.
Yeah, absolutely. I think credit rating does matter a lot. But remember that credit rating is the opinion of that particular rating agency. So it's not that there is some absolute value to that credit rating. For us as fund managers, credit rating is one input to making an investment decision. So we do not go by the credit rating in any investment that we make, but we require a credit rating, which is to say somebody else has also had a look at this bond and has analyzed it. It's exactly that. But from a portfolio perspective, especially when you're not a fund manager or an analyst, but you're looking at it as an investor, looking at the rating of the mutual fund, the scheme itself, many mutual fund schemes themselves are rated, or looking at the portfolio to see the ratings of the underlying bonds will give you a good sense about the quality. Now, if your viewers don't know what a credit rating is, it basically goes the more AAA, the A's there are, the better it is. So if you have 3 A's, that's a AAA, it's the highest rating. A double A is lower than that, a single A is lower than that, and then you get into triple B's and lower, which are significantly higher in risk. So what you want to see is a portfolio which has, especially if you want a quality bias, you want a portfolio which has most of the AAA rated bonds or government bonds, which of course are sovereign in nature. So these securities typically have very high quality. They also have very high liquidity, and that basically these are two very important aspects of safety which you need to keep in mind.
Okay, and lastly, What's the cardinal sin when investing in duration funds? I mean, what's the one thing that you just shouldn't do?
The one thing you absolutely should not do when it comes to duration is past performance. What happens in interest rate cycles is rates go up and rates go down, and the bond prices move inversely with changes in rate environment. So that is to say that when you have, for example, the last 3 years, when the yield on 10-year government bonds have come down from above 8% to around 6%. What that means is when you look at the last 2 years, 3 years return from bond funds, they look spectacularly high because the yields are coming down and prices are going up. I can explain how that mechanism matters if it's of use to your viewers. But essentially, the more the yields come down, the more the past returns look better. But what that means is today's yields have come down, and unless you expect the yields to come down in the same way that we have seen a 2 percentage points drop in yields, unless you expect to see another 2 percentage points drop in yields from here, the past performance simply doesn't guide you in terms of expectation of future returns. And the same way when you have a rising interest rate environment. So, for example, if we were having this conversation in the second half of 2018, after having seen perhaps a year or two of rising interest rate environment, the past returns look really, really bad because you have a rising interest rate environment. But that is the best time to buy. So, in fixed income and especially in duration, the past performance, especially very strong in either direction, very strong positive performance or very strongly negative performance, is usually a guide to do the exact opposite. So that means the story has played out. And I think this is something which you have to keep in mind. Please do not buy on the basis of past performance in duration funds.
Or in any funds for that, matter. I'll just
Oh
add
yes,
it as
oh
a
yes. Yep.
caveat.
It's applies across the board. But when you have funds which are specifically linked to this one character, which is interest rate, and they move in cycles, it's important to keep this as very. And if you look at, for example, money market funds or any of these funds which don't have that kind of a duration risk, they don't have this kind of wide movements in returns either. So therefore, looking at the past performance, while it's always never a good sign to use that as an indicator of future returns, it doesn't also drive you to buying something just because of the last past performance numbers look so good. So it's a caveat. It applies across the mutual fund industry, so please keep that in mind.
Shiva, thank you so much. We really appreciate your time today to try and talk about duration funds and for speaking in a language that we can understand so very easily. Thank you very, very much for simplifying this topic for us.
Thank you for having me.
Thank you. All right, with that, we have come to the end of this video. I hope you liked it. Please do send us all of your comments below, and we look forward to reading all of them and also replying to them. And if you have any suggestions for topics that you'd like to have discussed in the future, do put those down in the comment section too. Thanks very much once again